Aspens first half headline earnings per share increased by 17% to 371 cents. Revenue from continuing operations climbed 20% to 9 billion rand. The group says it expects its Asia Pacific business to replace South Africa as its largest revenue generator by the end of this year. Earlier, our senior anchor Bronwyn Nielsen spoke to Aspens Group Chief Executive Stephen Saad.
We talk about the negatives in sub-Saharan Africa. We had turnover growth. So our turnover grew by 19%, but our
EBITDA was down
10%. And if we look at it, yes, there was problems in Nigeria, but Nigeria actually grew. Kenya, we didn't grow because of the political unrest, but the year before it's Ivory Coast. So I don't look at that as an excuse. I think our strategy is to invest in as many of the countries as possible, and some do better and some do worse. I think probably what the results don't show is at a point, the acquisitive growth in Africa is hard, because to fix facilities in Africa is not easy. And so what we have done is we've invested in representation. So we've taken our representation up to over 600. So what we've said in the second half, it'll improve, but it's a case of when do you start that investment process. So we made the decision to start it now. Now maybe it was too soon, but we think
it will yield results. Are you expecting the next 6 months to see those results flowing through from the increased feet on the ground? So
yes, it's a quick return. It's people and heads, so it's not like a factory that might take years. So and Africa is growing, and we're banking on it being a good growth market. But to grow there, we need to put more products in and put more people on the ground. And we're hoping to get a very big presence across Africa. There's not many people, if any, that have our representation across sub-Saharan Africa.
Touching on South Africa, I see a reduced share of the public sector tender on ARVs. Is this a concern going forward?
So you'll see in this half, our turnover's up and our margins aren't up as much. A lot of it is because there's been a big growth in the ARVs. Are we concerned by a loss of a potential share in the ARVs? I've just been through too many ARV tenders. The reality is we end up with them. Already, this new tender that's supposed to kick in, Aspen, please will you extend, will you extend, will you extend? So our ARV tenders are higher than they've ever been right now. Now, do we worry about it? No, it's not a major profit center for us, but it does cause lots of disruption in our factories.
Who are you losing out to, though, in the initial tender space?
It depends where the tender goes, because we have won the biggest share of the 3-in-1 tenders. So you take one tablet 3 times a day. Now that is where the government's moving towards. How quickly does that transition take place? It's very hard to tell. But we were right in the forefront. Very difficult technology. We're the only company that can make those products in South Africa, that type of technology. But we're losing out in this instance. There's local manufacturers that have come in, importers from India as well.
Let's talk about Asia Pacific, and I see that you're expecting revenues to be bigger from that territory than South Africa in the end of the year, effectively.
Yes, it's very close, but they're
neck and neck at the moment.
They're neck and neck. I think it's going to be very tough. I mean, a lot depends on the rand dollar performance, but Australia has got an advantage in that we had that acquisition, which only came in for 1 month. So the acquisition of those products we bought from GSK, the prescription products, will now be there for 6 months. Also in the Asia Pacific region is Asia, which has really grown for us. So Asia is up over 60%. Our Philippines operation has more than doubled. So we've had good growth in those regions. Quite tough, for South Africa to compete against such a busy region.
You mentioned your acquisitions from GSK. Are you watching the debt levels very carefully?
Yeah, debt levels, I mean, we're covering interest more than 9 times. So we've got a very low level of debt. Even our interest cost is the same as it was the year before. So we're very strong in cash. We deliver a lot of cash as a business, and that's always important. And we also look very closely at what the difference is between our acquisitive growth and organic growth. No company can just keep growing acquisitively. And we've got a really strong balance. You'll see in South Africa, good organic growth. Australia, Asia, good. Latin America is up nearly 40%. So Brazil and the rest of Mexico. So our regions are all working. It's one of those sets of results that you can never ever
rest. I'm trying to find the downside, and there's no downside.
But you can never ever rest, and there's no time for rest. There's no time to celebrate. It's always you're on the treadmill. But most importantly for us, we've got really big plans.
Stephen, a little bit about your manufacturing plant. You are under cautionary at the moment, and what is the manufacturing plant in Europe going to do for the group?
So what we do when we look at all corporate activity, we say to ourselves, well, listen, how does this help us in a couple of areas? The first thing we look at is a pipeline. Will it give us a differentiated pipeline to help us grow organically into the future across our territories? Yes, it ticks that block. with the products we acquire, will it give us more critical mass so we can move from distribution models to our own models, so we get those success stories like the Philippines through, and that's what we hope. Those we hope the blocks that with this, if this acquisition goes through, those are the blocks it ticks.